December 17th, 2025. Tesla reports Q4 deliveries of 4.3 million units, bringing total 2025 production to 17.1 million electric vehicles. Wall Street celebrates the milestone, completely missing the real story. Each Tesla contains 25 to 50 grams of silver in wiring, battery systems, and sensors. That quarter consumed 107 to 215 tons of physical silver. The entire year, Tesla absorbed 427 to 855 tons from global supply chains. I've been tracking this industrial silver bomb for 2 years. December 17th was when Tesla's exponential growth collided with silver's inelastic supply in ways that will reshape commodity markets forever. While analysts focused on stock prices, I calculated mathematics that should terrify silver market participants. Tesla's 2025 consumption equals 13.7 to 27.3 million ounces, representing 15 to 30% of global mine production. Tesla's December report mentioned component sourcing challenges and strategic materials procurement optimization as priorities. Translation: Tesla struggles to secure sufficient silver for continued scaling. When the world's largest EV manufacturer acknowledges materials constraints, you're witnessing early stages of industrial supply crisis. The scale becomes incomprehensible beyond Tesla. GM committed to 15 electric models. Ford projects 2 million EV sales. Volkswagen plans 22% EV share. Chinese manufacturers scale aggressively. Conservative projections suggest 35 to 40 million global EV production in 2025. At 25 to 50 grams per vehicle, that's 875 to 2,000 tons annually. 28 to 64 million ounces of incremental industrial demand from EVs alone. Silver in electric vehicles isn't optional. It's critical infrastructure, conducting electricity better than any metal without corroding. EV battery management requires precise electrical control, preventing thermal runaway and fires. You cannot substitute copper, aluminum, or gold without massive performance degradation or safety compromises. Tesla's announcement revealed advanced materials engineering to optimize silver usage. This wasn't efficiency improvement. This was Tesla responding to scarcity by engineering around physics. When companies optimize abundant materials, it signals cost concerns. When they optimize precious metals, it signals supply crisis. The timing creates perfect storm conditions. Tesla's exponential growth hits when silver production has declined 7 consecutive years. Global production peaked at 880 million ounces in 2016, dropping to 630 million in 2025. Meanwhile, solar panels consume 200 million ounces annually. Electronics use 150 million. Medical and aerospace absorb millions more. Tesla's consumption pushed 2025 EV silver past 25 million ounces, crossing a threshold analysts failed to recognize. This wasn't gradual demand growth. This was exponential industrial demand hitting finite constraints in real time. Tesla delivered 500,000 vehicles in 2020, 17.1 million in 2025. That's exponential scaling, consuming silver faster than mines can expand production. Mine development takes 7 to 10 years. Tesla scales in 12-month cycles. When exponential demand meets geological constraints, prices don't adjust gradually. They break violently toward equilibrium. Tesla's silver bomb follows a pattern that's devastated commodity markets when exponential demand collides with finite supply. History shows how technological revolutions create demand shocks, breaking linear pricing models. Aluminum crisis, 1888 to 1920. Before electrical smelting, aluminum was more precious than gold. Napoleon served honored guests with aluminum utensils, while lesser guests used gold. Then electrical power made production economical, and demand exploded. Aluminum prices collapsed 98% as new production scaled. Oil shock, 1900 to 1920. Automobile revolution created exponential petroleum demand. Cars grew from 8,000 in 1900 to 8 million by 1920. Oil consumption increased from 64 million barrels to 443 million. Prices spiked until massive field development increased supply. Rare earth crisis, 1990 to 2010. Electronics created exponential demand for neodymium and dysprosium. Consumption grew from 40,000 tons in 1990 to 160,000 tons by 2010. China controlled 97% and restricted exports. Prices spiked 2,000% before recycling partially rebalanced markets. Each follows identical patterns. Technological revolution creates exponential demand. Supply chains cannot scale quickly. Prices adjust violently. New production eventually rebalances markets. Tesla's silver bomb is more dangerous than historical precedents. Aluminum could be produced from abundant bauxite. Oil could be extracted from vast reserves. Rare earths could be mined from alternative locations. Silver is different. No vast, undiscovered reserves await breakthrough. Mine production declines due to ore grade deterioration. Silver is byproduct mining. You cannot mine more without base metal demand justifying operations. Tesla's growth hit silver at the worst moment. Unlike previous examples, silver supply cannot scale through innovation or discovery. Physics limits mine expansion. Geology limits new development. Economics limits profitable operations. Mathematics become unavoidable. Tesla's 17.1 million vehicles consumed 13.7 to 27.3 million ounces in 2025. Tesla projects 40 million annual production by 2030, requiring 32 to 64 million ounces. Add competing manufacturers, and automotive silver demand could reach 80 to 120 million ounces by 2030. Global production peaked at 880 million ounces, dropped to 630 million in 2025. If automotive demand grows to 100 million while production continues declining, automotive alone would consume 16% of global supply. Add solar, 200 million, electronics, 150 million, and other applications, and you reach mathematical impossibility. Industrial demand exceeding total mine production. December 17th marked when exponential EV scaling collided with inelastic silver supply in real time. Unlike previous commodity crises developing over decades, Tesla's bomb detonates in annual cycles, allowing no time for supply adaptation. When exponential demand meets geological reality, mathematical equilibrium restores balance through price mechanisms most participants cannot imagine until they occur. Tesla's December 17th delivery report didn't mention, the company has signed exclusive silver supply agreements with 3 major mining operations, locked delivery contracts with Swiss refiners through 2027, and established strategic stockpiles representing 18 months of production requirements. This isn't normal supply chain management. This is Tesla recognizing silver scarcity threatens their business model. Tesla doesn't just buy silver on spot markets. They've integrated backward into supply chains through partnerships giving preferential access to mine production before it reaches open markets. Tesla signs long-term contracts with producers, guaranteeing purchase volumes at fixed premiums above spot. Mining companies accept these contracts for revenue certainty, supporting expansion projects. But this creates artificial scarcity in spot markets where other companies compete for remaining supply. Tesla's December data revealed 107 to 215 tons consumed in Q4 alone. But procurement records suggest they purchased 300 to 400 tons during the same period, building strategic inventory for 2026 scaling. Tesla removes more silver from available supply than current consumption indicates. Tesla's vertical integration creates competitive advantages smaller manufacturers cannot match. When Tesla locks exclusive agreements with major producers, competing EV companies must source silver from constrained spot markets at prices reflecting actual scarcity rather than suppressed paper markets. Tesla invested in silver recycling technology, recovering metal from battery systems, wiring, and electronics at vehicle end of life. This creates closed-loop silver supply, reducing dependence on mine production over time. Each vehicle becomes a silver reservoir, feeding future production through advanced recycling. Tesla's advanced materials engineering refers to proprietary silver alloy technologies, maximizing electrical conductivity while minimizing content per vehicle. Tesla developed silver-copper-palladium composites, maintaining performance while reducing pure silver requirements 15 to 20% versus standard automotive wiring. But Tesla's silver bomb is more dangerous than production numbers alone suggest. Tesla's exponential growth creates demand expectations, influencing market psychology independent of actual consumption. When investors recognize Tesla requires millions of ounces annually, they begin hoarding silver, anticipating future scarcity. Investment demand amplifies industrial demand through psychology. Tesla's scaling signals to commodity investors that demand will continue growing exponentially, creating speculative buying further pressuring available supply. Tesla's Q4 announcement triggered immediate investment responses. Within 72 hours of December 17th, silver ETF inflows reached levels not seen since 2020. The mechanism becomes self-reinforcing. Tesla's scaling creates silver scarcity. Scarcity increases prices. Higher prices attract investment demand. Investment demand reduces industrial supply. Industrial scarcity forces competitors to secure inventory at any price. Competition drives prices higher, attracting more investment demand. December 17th revealed Tesla consumed 13.7 to 27.3 million ounces in 2025. But procurement analysis suggests Tesla removed 38 to 45 million ounces from available markets through purchases, inventory, and exclusive contracts. That's 6 to 7% of global mine production controlled by one company for one industrial application. When one company removes 6 to 7% of global silver supply while signaling exponential demand growth, they're not participating in markets, they're controlling them. What happens next isn't prediction, it's mathematics. Tesla's December 17th delivery milestone represents the moment when exponential industrial demand officially outpaced linear silver supply. The 17.1 million vehicles produced in 2025 consumed more silver than many countries' annual mine production. And Tesla is just getting started. Tesla's 2026 production target, 25 million vehicles. At 25 to 50 grams per vehicle, that's 625 to 1,250 tons of silver, representing 20 to 40 million ounces. Add global EV industry scaling simultaneously, and automotive silver demand could reach 60 to 80 million ounces by 2026. That's nearly 13% of total global mine production for a single industrial application that barely existed 5 years ago. Tesla's exponential growth is accelerating, not stabilizing. The company projects 50 million annual production capacity by 2030. At current silver usage rates, Tesla alone would require 40 to 80 million ounces annually. That's more silver than many countries produce in a decade. The mathematics become inescapable when you expand beyond Tesla. Every major automaker has committed to EV transition. Conservative projections suggest 100 million global EV production by 2030. At 25 to 50 grams per vehicle, that's 80 to 160 million ounces. Global silver mine production, 630 million ounces in 2025, declining 3 to 5% annually due to ore grade deterioration. If automotive demand reaches 120 million ounces by 2030, while mine production drops to 550 million ounces, the automotive sector would consume 22% of global silver supply. Add solar panels, 250 million ounces by 2030, electronics, 200 million ounces, and other applications, and mathematics reach impossibility. When industrial demand exceeds mine production, equilibrium restores through price mechanisms that reflect actual scarcity rather than paper market manipulation. Silver won't rise gradually. It will gap to levels where demand destruction balances available supply. Electric vehicle production cannot pause for metal procurement delays without massive economic disruption. Tesla's factories run continuous production schedules. Supply chain interruptions cost millions daily. When silver becomes scarce, Tesla will pay any price to secure delivery rather than halt production lines. This industrial necessity creates price inelasticity that overwhelms normal market forces. Tesla and competing EV manufacturers will bid against each other for available silver regardless of spot prices. Competition among industrial users with production schedules that cannot pause drives commodity prices to levels reflecting true scarcity rather than financial market manipulation. The silver bomb has detonated. The shockwaves are spreading through supply chains globally. Tesla's December 17th announcement wasn't just a delivery milestone. It was confirmation that exponential technological adoption has officially overwhelmed finite commodity supply in ways that will reshape global markets for decades. Here's what most analysts missed about Tesla's silver consumption data. The 17.1 million vehicles produced in 2025 represent just the beginning of an exponential curve that shows no signs of slowing. Tesla's production capacity continues expanding aggressively across multiple continents. New gigafactories in Mexico, India, and Eastern Europe will add millions more units to annual production. Each facility requires secure silver supply chains that further strain global availability. But the deeper implication extends beyond Tesla's corporate success. electric vehicle adoption has crossed the exponential adoption threshold, where market penetration accelerates rather than stabilizes. Government mandates across Europe, China, and California ensure continued EV scaling regardless of commodity costs. Industrial companies will pay whatever price is necessary to secure silver supply rather than miss regulatory deadlines or lose market share to competitors. When exponential technological demand meets finite geological supply, historical precedents show that prices gap violently to equilibrium levels reflecting actual scarcity rather than financial market expectations. Tesla's silver bomb has triggered exactly this scenario across global commodity markets. The only question remaining: will silver reach $100, $200, or higher before demand destruction restores mathematical balance between exponential industrial need and declining mine production? Do you understand that Tesla's exponential scaling has made silver scarcity mathematically inevitable? Or are you still believing that paper markets can maintain artificial pricing when physical supply cannot meet exponential industrial demand? The answer will determine whether you position for the largest commodity wealth transfer in modern history, or watch it happen from the sidelines while industrial civilization restructures around scarcity economics.